For decades, China's economy was synonymous with relentless export growth, powering global markets and fueling its own rapid development. Factories across the country churned out everything from electronics to textiles, shipping goods to every corner of the globe. This export-driven engine not only transformed China into the world's manufacturing powerhouse, but also lifted millions out of poverty and reshaped the global supply chain. But October 2025 brought a jarring reversal. Exports fell by 1.1%, the sharpest drop in months, erasing September's robust gains and sending shockwaves through the business community. The slowdown was felt across industries, from electronics to machinery, as global demand faltered. This wasn't just a blip. Economists had expected 3% growth, not a contraction. The surprise downturn caught many off guard, raising questions about the resilience of China's export sector in a changing world. The sudden downturn has rattled markets and exposed the fragility of China's export-driven model. Investors are now rethinking their strategies, and companies are bracing for more uncertainty ahead. Imports, too, barely grew at 1%, signaling weak domestic demand and raising concerns about China's ability to drive global growth. The tepid import numbers suggest that Chinese consumers and businesses are holding back, wary of the uncertain economic outlook. The slowdown in both exports and imports points to mounting pressures, a cooling global economy, persistent geopolitical tensions, and shifting trade patterns as companies diversify supply chains away from China. For Beijing, the challenge is clear: navigate a tougher global market while trying to spark domestic consumption. Policymakers are now under pressure to introduce new measures to stabilize growth and restore confidence. The era of automatic double-digit export growth is over. China must now adapt to a world where competition is fiercer and growth is harder to come by. How China adapts now will shape not just its own future, but the global economic order. The world is watching to see if China can reinvent its growth model and remain a key player in the international economy. October's export slump is rooted in the ongoing US-China trade war. Chinese manufacturers had rushed shipments to the US to beat new tariffs, but that temporary boost has faded. The result? Shipments to the US plunged over 25% year-on-year, a dramatic collapse. This drop has shaved about 0.3% off China's GDP, a major blow for an economy already slowing. The trade war's tariffs and barriers remain, forcing Chinese firms to grapple with higher costs and deep uncertainty. The once symbiotic US-China trade relationship is unraveling, exposing China's vulnerability to over-reliance on a single market. For Beijing, the lesson is clear: diversify or risk further shocks. The urgency to find new partners and rebalance toward domestic growth has never been greater. The trade war's shadow still looms large over China's export engine. Facing US headwinds, China has accelerated efforts to diversify its export markets. The results are mixed. Exports to the EU inched up just 0.9% in October, reflecting broader global weakness. In contrast, exports to Southeast Asia jumped 11%, thanks to deepening ties and regional trade agreements. Yet, even rapid growth in emerging markets can't match the scale of lost US demand. Annual sales to America once topped $400 billion, a gap not easily filled. While Southeast Asia, Africa, and Latin America offer promise, their combined purchasing power still falls short. China's pivot is a marathon, not a sprint. The pain of decoupling from the US is immediate, while new markets will take years to develop. For now, China's export momentum remains under threat. Diversification is essential, but the transition is proving slow and challenging. Despite a recent decline in exports, China's trade surplus with the US actually widened in October, reaching an impressive $24.8 billion. This figure is especially striking given the broader slowdown in global trade, and it underscores the complex dynamics at play between the world's two largest economies. This paradox is driven by an even sharper drop in US exports to China, which highlights not only weak Chinese demand for American goods, but also the shifting patterns of global consumption and production. American manufacturers are struggling to find buyers in China, and this imbalance is becoming more pronounced. The persistent trade surplus remains a major political flashpoint in Washington, fueling heated debates and calls for tougher trade measures. Lawmakers and industry leaders argue that the imbalance threatens American jobs and manufacturing, making it a central issue in U.S. economic policy. Europe, too, is growing increasingly wary. China's surplus with the EU is nearly as large as with the US, sparking similar concerns over market access, fair competition, and the future of European industries. European leaders are now rethinking their trade relationships with China. These dual surpluses make China a prime target for global protectionism, even as overall trade volumes shrink. Countries are increasingly considering tariffs, stricter inspections, and other barriers to shield their own economies from perceived unfair competition. For Beijing, managing these growing imbalances is as much a diplomatic challenge as it is an economic one. Chinese officials must balance domestic priorities with the need to maintain stable international relationships and avoid escalating trade conflicts. The risk is clear: a rising global backlash just as China needs new partners and fresh markets the most. The world is watching closely, and any misstep could have far-reaching consequences for China's global standing. Navigating these mounting pressures without sacrificing growth will be a true test of China's economic strategy and adaptability in a rapidly changing world. The world's appetite for Chinese goods is evolving, and so is the political climate. Consumers and governments alike are reassessing their reliance on Chinese products, adding new layers of uncertainty. The stakes for China's export-driven model have never been higher, and the path forward will demand both resilience and innovation. A recent truce between President Trump and President Xi offered a brief respite in the trade war, capturing headlines and sparking cautious optimism among global markets. For a moment, it seemed as if tensions might ease, and the world watched closely as both leaders shook hands, signaling a temporary halt to hostilities. Both sides agreed to pause new tariffs and trimmed a few existing ones, offering some relief to businesses caught in the crossfire. However, the core barriers and deep-rooted disagreements between the two economic giants remain firmly in place, with little progress on the most contentious issues. US-bound Chinese goods still face punishing tariffs averaging 45%, levels that erase profit margins for many exporters and force companies to rethink their strategies. The cost of doing business has soared, and many firms are struggling to adapt. The truce is a pause, not a peace. It freezes the conflict, but leaves fundamental disputes unresolved. The underlying tensions and mistrust between the US and China continue to simmer beneath the surface, making any lasting resolution elusive. For Chinese firms, exporting to the US remains barely viable, and uncertainty clouds every business decision. Many companies are hesitant to invest or expand, unsure of what the future holds or when the next round of tariffs might strike. The temporary reprieve hasn't revived trade flows. The economic disincentives are simply too strong. Shipping volumes remain low, and the ripple effects are felt throughout the global supply chain. With the truce set to expire in a year, the risk of renewed escalation hangs over every deal. Companies are forced to weigh short-term gains against long-term risks, making negotiations fraught with anxiety. Long-term planning is nearly impossible, pushing supply chains to shift away from China. Businesses are diversifying production, seeking stability in other countries, and reimagining their global strategies. The trade war's architecture is intact. Only the pace of escalation has slowed. The threat of future conflict remains, shaping decisions at every level of international commerce. For now, the uncertainty is the only constant, leaving businesses and policymakers alike bracing for whatever comes next. With exports faltering, China's leaders are racing to boost domestic consumption, the so-called dual circulation strategy. But October's weak 1% import growth reveals the challenge. Chinese consumers and businesses are holding back. Sluggish imports signal a cooling economy, not the robust demand needed to offset export losses. Beijing's new 5-year plan aims to raise household consumption's share of GDP, but deep-rooted issues persist. High savings rates, income gaps, and a property slump all weigh on consumer confidence. Stimulus can help, but genuine demand takes time to build. As external growth fades, China's future hinges on unlocking the spending power of its 1.4 billion citizens. The race to fortify domestic demand is on, and the outcome will define China's next decade. China's import data offers a window into its domestic economy's strengths and weaknesses. October saw record soybean imports and rising crude oil and iron ore purchases, signaling state-backed infrastructure and stockpiling. But copper imports, a key indicator for construction and manufacturing, fell, reflecting a deepening property crisis. The divergence is stark. Heavy industry and state projects are holding up, while private sector activity and real estate are struggling. This split exposes the limits of Beijing's stimulus, which props up state enterprises but can't revive private demand. The weakness in copper is a warning sign for the broader economy. China's growth is increasingly uneven, with old engines sputtering and new ones yet to fire. The data tells a story of transition and mounting challenges. Economists agree. China faces a tough road ahead, squeezed by both global and domestic pressures. The artificial boost from front-loading U.S. shipments is gone, forcing a pivot to domestic demand that's proving slow and difficult. Global slowdown, not just U.S. tariffs, is weighing on exports, so even a trade truce won't solve everything. Analysts predict a rough patch ahead, with weak demand at home and abroad. The old U.S.-China trade model is being dismantled, making diversification a permanent necessity. In the short term, Beijing may turn to fiscal stimulus and state-led investment to stabilize growth. But this risks delaying the shift to a more consumption-driven economy. China's policymakers must balance immediate stability with long-term reform, a delicate act in uncertain times. October's trade data is a snapshot of a world in flux, and China at a crossroads. The factory of the world model is under its greatest strain yet, as exports fall and global demand cools. China's push to diversify markets is making progress, but can't yet offset the loss of U.S. sales. Meanwhile, efforts to boost domestic demand face deep structural hurdles. Policymakers are caught between short-term stimulus and the need for long-term change. The global order is fragmenting, with supply chains shifting and economic nationalism rising. As the world's top trading nation, China's next moves will shape the future of global commerce. Its ability to adapt, by finding new markets, spurring domestic demand, and managing rivalries, will determine not just its own fate, but the world's. The world is watching as China navigates this pivotal moment.